All right, good morning. We're starting now. It's 10:30. The topic for today's call is self-employed income borrowers and how does it work getting a mortgage? I think if you're an advisor and you're watching, the number one thing right now, we'll talk to you because there's a lot of you guys and gals that want to buy a house. So if you're a new advisor, we've worked with a ton of new advisors on their mortgages. So you're paid a 1099 from your investment income, and you're paid a W-2 from your insurance premium income. And so you're a statutory employee, but when you file your tax return, you file it on a Schedule C, and ultimately you are considered a commissioned and or self-employed person. Right? Andy, you're nodding your head. Yeah. So the key, can you tell Rob to he's go somewhere else? The our office is quiet. It's loud all in the same breath. So when you're self-employed and or commissioned, the big thing in the mortgage business, and this is confusing and concrete together. The confusing part is it depends on how long you've been self-employed. That determines how much of a window we look at your income and for what time we look at your income. I was talking to Nick Hutchison. I know he's one of the top guys in the nation with your firm that sells disability insurance. And he was telling me yesterday that disability insurance, the way it works is that you cap out at, is it $20,000 a month is the most disability you can receive? I think. I could be wrong. But really what they look at is the previous year, the 1 year of income to determine your income. And they will typically, let's say you went from a W-2 to self-employed, they'll look at it more leniently because, hey, they're making the assumption that, hey, if you were W-2'd as a doctor for $500,000, but then you went to some firm that was paying you a 1099 and now you're a self-employed doctor, that as long as those were somewhat similar, that like the disability underwriter would use that income. Here's the deal. In mortgages, Fannie Mae writes the rules, and they tell us the window of time that we have to look at the client's income. So I'll start with you, Andy, because you've seen a lot of self-employed people through the years working with me as like on my team and now on your own. Add a couple bullet points to that of what I just.
Yeah, I'd say, super important, obviously, is the timeline and how long someone's been self-employed. Everybody pretty much knows that the 2-year kind of standard is a non-negotiable. You have to have 2 years of self-employed income on tax returns before you're going to be able to get a traditional mortgage. How the income is reported, because we all not going to look good on a mortgage application because the underwriter is only going to be looking at taxable income versus what like actual gross sales. So timeline super important, but then also too how the income is reported.
Just so you know, Andy, they do the same with a disability. It's the taxable income after expenses. It's not the gross. I was going to pull up a calculation sheet. One of the things that most people don't understand is, and I'm going to wait for this little spreadsheet, but when you're factoring the self-employed income, the key, and I think McCain's on the call, you're new on the team and you help kind of go through, but think of it like it probably for your client, in my opinion, if they're self-employed and they have their last 2 years of tax returns and they're relatively organized, a really good mortgage lender with their team, typically like an assistant and a processor, should be able, think of it like a legal team looking through like dockets of information to compress and to go, okay, here is the number that the judge will agree to. The judge is our underwriter. So I tell people and my team here that it's probably every bit of a 1.5 to 2.5 hour, maybe a 3-hour window where a bunch of eyeballs are looking at this and you're running the numbers. It's research time. So if one of your clients is like, hey, how do I get a loan and where do I go? And you're not immediately saying something like, hey, it's going to take at least a day for a lender, a good lender, to look at your tax returns and look at the last couple of years and look at your P&Ls right now, and maybe even your bank statements. And they should be able to come back to you after a really deep look and then say, okay, here is your average. You know, it looks like you're doing better now. So we think that if we take all of these numbers, that our underwriter on a preliminary basis would agree that you make, you know, $20,000 a month or $240,000 a year. Now, remember, most times your client is already making in their mind like $400,000 a year, and we're telling them, hey, we're using $20,000 a month or $240,000 a year in income. So any way you cut it or slice it, as an advisor, I would tell you that when your clients are commissioned, and you're going to have a lot of entrepreneurs in your day that, you know, they own a company, they start up another company, they own some rental property, they've got investments, they're moving and shaking, and their income isn't, they don't just walk in your door and say, hey, I work for Ernst & Young. Does that company even still exist? Ernst & Young. I work for Ernst & Young and I make 200 grand, and my wife works for Vanderbilt and she makes 100 grand. That may be 50% of the clients. So they make 300 grand between the two of them, W-2 divided by 12. Hey, their monthly income on a loan application, $25,000 a month. I mean, that's something that no offense, that a Rocket Mortgage cubicle person who literally is day 3 on the job, McCain, could answer.
You still love those files.
You love those files. Yeah, like you're like, hey, I'm so new, I can't screw this up.
Yeah.
But who's the iPhone? Is that Rob? The iPhone is, if you're watching and you're an advisor, the iPhone is Ron Chuddlestein. He's the largest. He just sold the most amount of premium in September. He sold 140 million in premium this month, and he's on the call as an iPhone listener.
It's 142 million.
142 million. He just closed out a 401k acquisition for 87 million assets under management. He's going to be the top producer this week. Excuse me. I'm sorry. That's Rob. He's in our office. He's just iPhone guy.
There we go.
There it is. So calculator, quick reference guide, Fannie Mae. So check it out. W-2, interest income, Schedule C. So that's normally what we see, or we see, we'll get to the next one. So Schedule C, check it out. You can add back, you see the little pluses and minuses? We can add back in depreciation. We being the industry of the mortgage world, because Fannie Mae tells us that we can. Business use of home, you can add in mileage, car mileage, business mileage, amortization. Then you subtract non-deductible meals and entertainment, and then you come up with a number. Scroll down a little bit further. So that's, you know, again, I say it takes 1.5 to 2 hours. Once you get good at it, it might take you an hour to go through a return and really determine the income. Schedule E, check it out. That's where people own real estate and properties. And Schedule E gets complicated when the Schedule E is a partnership return that becomes a whole nother thing that you have to look at, because they run a separate corporate return under a tax ID number that's to the corporation. And that starts to get a little more complicated. Scroll down a little bit more, Andy. Farm income. I think I've done one of those in my entire life as a mortgage person. So skip that, keep going. Partnerships, here we go. So the partnership returns, that's what I was talking about. Form 1065. And this is when your clients get sophisticated enough where they have an accountant. The accountant says, hey, it's better to do a partnership, and I'll pay you, I will distribute you your income on a K1, and I'll pay you quarterly because I'm your accountant. And at the end of the year, you'll get a K1 that shows how much distribution you took from the company you own. So this gets a little more complicated. There's more lines, but similar. You can add back depreciation on that line 8C, similar deductions and add-ons that come into play. One that's always fun that I tell people, see that mortgage notes payable less than 1 year. That's always a fun one when people have like a line of credit that they borrow against that they have to pay back, and their company on paper looks like it's doing well, but they borrowed a bunch of money short term to kind of keep it afloat. Well, that line right there has messed up some income calculations through the years. But we're in the major minutia. Like if you're an advisor and you're going into a big meeting, you sometimes, you have to get down into the nitty gritty of an analysis of an insurance product or an investment product. This is where the nitty gritty in the mortgage business and calculating people's incomes and really doing the work matters, because it makes things easier eventually to tell the client, hey, here's exactly what's getting ready to happen. Grant, any thoughts on any of this as you've gone through some self-employed stuff in your time?
Really, the big thing on self-employment that I like to stress is we kind of have that, you have to have 2 years of income, right, Brendan?
Yeah.
But 2 years as a self-employed individual can be, you could start in the middle of a year.
Yeah.
So the big thing that I like to kind of stress with self-employed individuals is we're really qualifying to tax seasons, not necessarily 2 years of income always. Correct?
Mm-hmm. Yeah.
So with 1 year, if you started in the middle of the year, you would only have 6 months of income. Then the next year you have 12 months. Then the next year after that, you have another 6 months. Technically you're at 2 years, but we're only using 18 months to qualify.
Right.
Right. So I think that's pretty important to stress. I think when qualifying income, I think sometimes self-employed individuals, obviously income usually ticks up pretty quickly. That's just something I always like to add in. And, when I'm kind of educating anybody that's self-employed.
Yeah. It's the tricks of the trade, right? It's when the numbers come in. And by the way, we do need 2 years when you're looking at most products. But let's say you have the client that opened up the popsicle stand in 2015, and they have a state license in Tennessee for the popsicle stand. And here we are in 2022, and their 2020 was terrible because popsicles during COVID didn't sell. But then in 2021, they expanded and did great. So there are products that allow us to look at the most recent 1 year if they've had their business in place for a minimum of 5 years. So we always say the 2 year because you always want to look at 2 years, but there's nuances to not having to look at 2 years. Any other thoughts on this? This is about as boring of a call as we could have, but there's so many nuances to self-employed that allow you, the advisor, to look good when you're advising your clients as their wealth manager. Like if you can get them in touch with resources that can help them borrow money more creatively because there's an intelligence factor in calculating the income and the review, then you as the advisor are absolutely putting yourself in a position with the team around you to help more self-employed people and commissioned income people. So I just firmly believe that, and maybe Benton, that's the clip that we need to put out there, is that this is the key to being the advisor that your clients go, oh, John or Betty, they're awesome because they know this stuff and they put me in touch with the right people that help me, because I don't want to go to a bank and get told no. I don't want to walk in somewhere where someone doesn't know how to calculate income and then I hear no when I'm trying to go buy my next house and I'm all excited because my business is doing better. And then some banker says, oh, your business stinks and I can't give you a loan. So nobody wants to hear that. And I think that's one of the big keys for every Northwestern advisor to kind of meddle in their client's business around real estate and around getting mortgages when they are self-employed, because this is where there is a division of, think power and knowledge that, I mean, you guys all can nod your head when we've seen someone told no. We look at their thing, we look at their returns, and for whatever reason, someone just didn't know how to calculate their income. And we're like, wait a minute, we can add depreciation, we can do this, like your income's this. And they're like, really? And we're like, yep, we can approve your loan now. So Andy's nodding his head because you've seen it. I've seen it all the time. So any other final closing thoughts? I mean, we're rolling in on 20 minutes here. Self-employed, commission income.
Yeah, I was gonna say, like, the huge value of knowing how this works. Like, you don't have to know the details, but as an advisor, if you know how it works and you can get your client with a mortgage professional who can actually dig in and help them set up maybe their next year's returns so that they will be able to buy next year, versus, oh, they totally screw it up the next year's too, because they deduct every last penny. And then now they're 3 years out from buying a house instead of a year or two. And during that time, all they're focused on is saving for a down payment, and they don't want to invest with you. They think life insurance, is something that they're going to do after they buy a house. So like the whole idea is get them educated as soon as possible, get a CPA involved, get someone else who will make sure that their taxes, is filed correctly. And then the value there is they get to buy sooner and then start investing quicker after they buy their house, because the house is the priority in a lot of people's eyes.
Yeah. Yeah. The tax prep planning is huge because, we have one right now, and irony, he probably needs an advisor. So I need to refer him out shortly, but he's got depreciation, he's got all this stuff, and his 2021 looked really good with depreciation. And he says to me, well, so I'm going to have to wait till I file my 2022 because my 2022 income right now is even better than my 2021. And then I said, well, yeah, but in 2020, could you have taken some of the depreciation on your equipment and your stuff? And he goes, maybe. So he calls me back and he says, my accountant can amend my 2020 return. I'll just owe a little bit on, income, like unpaid income tax. It'll change my net income and a little bit on the return. But, if I only had to pay a couple grand in income tax, but now hey, it's September, so I could start looking at a home in October, November, December versus waiting until the end of, January, February to file his next return. That's, this is all just tricks of the trade to kind of, Grant, you said it. We're not really looking at, you can look at years like from January to December, or you can just start to kind of be more creative and essentially bend the rules, or you can amend a tax return. And, the funny thing about that, while we're going down a little bit of a rabbit hole of detail, is that an amended return, it takes a minute to process through the IRS so that you can show an underwriter, hey, the return that they filed in 2020, they changed. Here's the one they changed. So now we're going to use that income. It takes a minute. And this is expertise stuff. This is not rookie loan officer mortgage stuff. This is high tech, high tune.
Yeah, something else. I always want to mention one more thing. A lot of business owners, especially Northwestern Mutual business owners, they are doing a lot of extensions on tax returns, I've noticed. Right? So if you're extending your tax return and you're self-employed, that following year's income, we cannot use it until you have filed to the IRS and we show that you paid the bill. So extensions are kind of a thing that people come in our office, they're really excited to get a house. But if they haven't filed for that previous year yet, we can't use that income yet. So we're actually bouncing to another tax season back. So sometimes that's a stickler that ends up, we obviously, Brendan, you see it every single day. Andy does as well. So,
Yeah.
I've had those instances happen quite a bit.
Well, and you mentioned it, Grant, that like when they come in, they're so like, oh my God, my business is doing great. Yeah. And then we're having to go back. Like if they haven't filed and they filed an extension, we're like, oh, well, we need to go back 3 years and 2 years. And it's like, oh, well, yeah, that was COVID and I did this. And oh, I was taking care of my aunt. Oh, there was some bad stuff in those times. But then, at the beginning of 21, it started to get better. It's like, all right, well, so there's a lot of planning, just like when you're trying to organize someone's life in what you guys do in investments and assets and insurance needs and disability products. And you go, man, this is just a lifelong journey with self-employed people and mortgages. The more time we have to get in front of them to really look at the numbers, the better off they're always going to be, because there's nothing worse than when they get excited, they want to go buy the place next week and everything unravels. So we'll edit this. You know what we need to do? I would like with you guys before we hang up and we get it on camera that we do a little cheat sheet from today about self-employed, and we send that out to the guys that we're working with and gals, just as, hey, if you missed the call, here's a quick cheat sheet on self-employed individuals that are trying to buy houses and maybe some of the differences so they can see that. And our next week call is what? Best routes to invest in real estate. Well, that'll be a good call because, boy, everybody has an opinion about that. So everybody will get a chance to speak. We'll get Rob off the iPhone. Maybe Aaron will join us too, because he can tell us his story about him being one of the first Airbnb short-term rental guys in Nashville and that journey and what that's looked like. So that'll be a good call. It might go a little longer because we'll talk about the different places to invest in real estate, and everybody on this call has done it. So except for McCain, but that's happening soon. So thanks again. We'll see you guys next week, and we'll send out any notes on this one that we drum up here in the next hour.